We are taught to view the stock market as a rational mirror of the real-world economy. In theory, if a company reports strong earnings, its stock goes up. If unemployment spikes or a recession looms, the market goes down. In 2026, that traditional mirror has lost its clarity. Market valuations are diverging from standard economic indicators as investors prioritize AI potential over current revenue and fundamental data. This chart tracks the price-to-earnings ratios of the tech sector against historical norms. For decades, the long-term average sat around 16. Right now, NVIDIA trades near 47 times earnings, Palantir sits near 400, and Datadog is trading at 430 times earnings. Traditional logic fails to account for these trading multiples. When the price of a stock reaches 400 times its earnings, it is no longer being valued on its current business, but on the hope of future dominance. To see this disconnect in action, look at the events of April 8th. Following a sudden ceasefire announcement the previous evening, the markets opened and immediately rallied. The Dow gained over 1,000 points, marking its best day in nearly a year. Financial media framed this as a relief rally, claiming investors were celebrating peace. But maritime intelligence firm Windward used digital GPS signals and satellite radar to show the conflict was continuing. By midday, outbound carrier activity through this choke point dropped 96%, with only 5 ships detected. The market hit all-time highs, while global shipping remained at a standstill. Prices reached a record peak, while real-world trade was effectively frozen, suggesting the rally had little to do with the actual geopolitical situation. Going into April, Wall Street was positioned for a decline. According to prime brokerage data, hedge funds were sitting on record leverage and aggressively shorting the market at the fastest pace seen since the pandemic. This is the mechanic of a short squeeze. When you short a stock, you borrow shares to sell them, hoping to buy them back later at a lower price. But if the price goes up, your broker may issue a margin call, requiring you to buy back those shares immediately to cover the position. The initial ceasefire headline provided a small price bump, but that was enough to trigger mass margin calls. This forced thousands of short sellers to buy at once, creating a sharp upward spike in price. This initial rally was a mechanical response to over-leveraged short positions. When the price ticked up, the forced buying from margin calls became the primary driver of the surge, regardless of whether the ceasefire was real. The short squeeze then activated the next group of market players, commodity trading advisors, or CTAs. These are systematic trading firms that use rules-based models. They are algorithms designed to follow price momentum without human intervention. As the squeeze pushed the S&P 500 higher, it crossed specific mathematical thresholds. These price levels triggered CTA models to instantly flip their positions from short to long. This chart tracks the resulting buying volume. Over the following 5 trading sessions, these algorithms bought $86 billion worth of equities. According to Goldman Sachs, it was one of the fastest buying speeds in market history. These algorithms do not read the news or analyze geopolitics. They act as a blind accelerant, ensuring that once a rally begins, mathematical momentum keeps it moving. The final domino was the options market. To remain delta neutral, options dealers are forced to buy the underlying stock as prices climb, to hedge their risk against incoming call options. This activity sits on top of a foundation of passive index funds, which now hold over $13 trillion. This is money that operates on autopilot, buying stocks based on a set index rather than active research. Because most of these funds are market cap weighted, new capital is funneled directly into the biggest companies. The larger a company becomes, the more the passive funds are required to buy. This has led to an extreme concentration in the S&P 500. Just 7 tech stocks now account for 35% of the entire index's value. When algorithms and options dealers push the market up, passive funds automatically pour more money into these same top-heavy stocks. This creates a self-reinforcing feedback loop that functions independently of corporate performance. The market has shifted from a landscape dominated by human analysts modeling cash flows to one controlled by algorithmic loops and automated flow. This structural concentration creates a specific danger. Because the index is so reliant on a handful of stocks, a stumble from one major name could cause the entire automated system to run in reverse, triggering blind selling across the board. Using historical averages or traditional economics to predict these moves is difficult because the mechanics have changed. As John Maynard Keynes once said, Markets can remain irrational longer than you can remain solvent. The evidence from 2026 indicates that financial headlines frequently act as convenient narratives for moves dictated by math. To navigate this environment, we must focus on the mechanics of the system rather than the stories used to explain it. Let's talk about the bedrock